Good morning, everyone, and welcome to today's lecture. And thanks for joining us. I'm Alicia, and I'll be your tutor for this accounting lecture today. Just a little bit about me first. So, I graduated Year 12 in 2021 with an ATAR of 94.95, and currently I'm studying a double degree of Information Technology and Science at Monash. Before we get started, just to let you know, if you have any questions at all throughout this lecture, feel free to ask them at any point, and I'll be online and answering them as they show up. Okay, let's just get started. So the non-current assets that businesses own can either become worn out or damaged as they age or become older, or they can be superseded by newer models of that same asset. So, for example, say if the business owns a laptop or a computer, and then they've had that laptop for 1 or 2 years, and then after those 2 years, say if it's an Apple laptop, Apple decides to come out with a newer model of that same laptop. And so even though there's nothing inherently wrong with the laptop that they already own currently, they might still decide to buy the newer version of that laptop because obviously the newer model will have, newer features, better features, it'll run smoother, it'll work better for the business, and so it'll have a greater revenue earning potential. And so even though the current laptop that they own isn't necessarily worn out or damaged, the business might still decide to purchase the newer model as it comes out. And it's kind of similar to, when you have a phone, sometimes there's nothing necessarily wrong with your old phone, but you still decide to buy a new phone when the newest model comes out. So that's kind of similar with businesses. So it's just important to note that when we're disposing or selling a non-current asset as a business, it's not always just because of damage or the asset being worn out. It is some of the time that it is damaged or worn out, but it also is, the older model becomes superseded or there's a better model available. And so when we do dispose of a non-current asset, we have to adjust the accounts to show that the asset is no longer available, and also the business may make a small gain from this disposal. So they'll either get cash from the sale of a non-current asset or a trade-in value that goes towards the purchase of a new non-current asset. And it's important to note that disposal refers to both the sale and the trade-in. So a lot of the times I think it's easy to just assume that it's a sale most of the time, or when you think of disposal you think of a sale of a non-current asset, but you also need to understand that it can also be a trade-in value as well. So for recording the disposal of a non-current asset, there are 3 entries that we need to show. So we need to record the disposal of the non-current asset at its carrying value. We need to show the revenue earned from the disposal or the proceeds on disposal, and profit or loss on disposal, which is just the difference between the carrying value and proceeds from disposal. So obviously, if the carrying value is less than the proceeds from disposal, then it'll be a profit. And if the carrying value is greater than the proceeds from disposal, it would be a loss on disposal. And to record the disposal of a non-current asset, we need to open a new ledger account, and it's a temporary ledger account called disposal of non-current asset. And non-current asset is kind of like a filler. So if we're disposing of a van, the account would be called disposal of van. If we were disposing of a laptop or a computer, it would say disposal of computer, etc. So step 1 is to transfer the carrying value of the non-current asset. So the first double entry is we increase disposal of asset, or we debit disposal of asset, and we decrease asset by crediting asset. And then the second double entry is we decrease accumulated depreciation by debiting accumulated depreciation, and we decrease disposal of asset by crediting disposal of asset by that accumulated depreciation amount. So here's an example. So on the 31st of December, after 3 years of use, the business sells a van which had a cost price of $25,000, and on that sale they earn $4,000 worth of cash, and the accumulated depreciation of that van was $15,000. So this is how we do that step one, which is to transfer the carrying value. So we debit disposal of van to increase disposal of van by $25,000, which is that initial cost price or purchase price of the van. And then we credit or decrease van $25,000. And then to transfer the accumulated depreciation amount, we debit accumulated depreciation of van or decrease accumulated depreciation of van by $15,000, and we credit disposal of van to decrease disposal of van by $15,000. So we transfer the cost price and we transfer the accumulated depreciation, which in essence is transferring the carrying value, because everyone knows cost price minus accumulated depreciation is the carrying value of a non-current asset. So by transferring those two balances, transferring the balance of the van, which will be the cost price of the van, and by transferring the balance of accumulated depreciation of van, which is the accumulated depreciation, we are transferring the carrying value of the non-current asset. So note how this transfers carrying value, which is cost less accumulated depreciation, as I was just saying. And also note, like I was saying earlier, because we're, in this case, in this specific example, we're disposing of a van, the temporary ledger account is called disposal of van. If the example was disposing of a computer, then the account would be called disposal of computer. So that temporary account, its name can change depending on which type of non-current asset we're disposing of. And this is how this will look in the disposal of van ledger account. So you can see on the debit side, we have a debit entry of $25,000 and the cross reference is van, and on the credit side, we have a credit entry of $15,000 and the cross reference is accumulated depreciation. And then the date is the date of the disposal. And this is how the van ledger account looks after this transferring. So we can see that on the debit side, we have a debit entry of $25,000 and the cross reference is balance. So that is just the balance of the van, which is that $25,000. And then on the 31st of December, on the credit side, we can see a credit entry of $25,000 and cross reference is disposal of van. And you can see here that disposal of van has been abbreviated just because there was no room, but you know, in your SACs and in your exam, you can't abbreviate any of the ledger account names in the cross reference. And then this is how the accumulated depreciation of van ledger account looks. So we had the opening balance on the credit side of $15,000, which was the total accumulated depreciation of van. And then at the end of the month, when we're doing the disposal of the van, we have the debit entry on the debit side of $15,000 and the cross reference is disposal of van. And again, you can't abbreviate that name. And you'll notice that after these entries have been recorded, the van and accumulated depreciation of vans are now reset to zero. So those accounts had an opening balance, and then, so in the van's case, the opening balance was on the debit side, and then there was a credit entry on the credit side of the same amount as that opening balance. And so essentially it's 25,000 minus 25,000, which resets the van account back to zero. And same thing with accumulated depreciation of van. So we had the opening balance on the credit side of $15,000 and the debit entry on the debit side of $15,000, which essentially resets the accumulated depreciation of van account down to zero. And this isn't always the case. Sometimes the business can own multiple vans or multiple of the same non-current asset, and so then the balance of the account might be talking about multiple non-current assets. So for example, if they own 2 or 3 vans, then the van account would be, the balance would be multiple vans. But in this case, it is only one van that the business has on hand, so it does get reset to zero. But just note that the resetting to zero isn't always what happens. Yeah, because it just depends how many of that non-current asset the business has. Okay, so that was step one. Now, step two, so obviously step one was transferring the carrying value of the non-current asset that we're disposing of. So transferring the cost price, transferring accumulated depreciation, and because cost price minus accumulated depreciation is the carrying value, in essence, we were transferring the carrying value of that non-current asset to the disposal of non-current asset, or disposal of van, in this case, disposal of van ledger account. So that was step one. So now step two is to record the proceeds received or the revenue earned from either the sale or the trade-in of the disposal of the asset. So if there's a cash sale, then that means the proceeds means cash received from the sale of the disposal, from the sale in the disposal of the non-current asset. So in the case of a cash sale, we'll have an increase in bank or a debit to bank to show that the business is receiving cash for that sale, and an increase in disposal of the asset or to credit disposal of the asset. So let's go back to that same example from before. So on 31st of December, again, after 3 years of use, the business sells the van, which had a cost price of $25,000 for $4,000 cash, which is referenced by receipt 32. And the accumulated depreciation was $15,000. So this is how that transaction looks once we've recorded step 2. So we have the date 31st December, and then we debit bank 4,000 because it says in the question that the business receives $4,000 cash for the cash sale of that van. So we debit bank 4,000 to show the increase in our bank, the business's bank account of that $4,000, and we credit disposal of van $4,000 to show that that was the proceeds on the disposal of van, and to transfer the proceeds amount to disposal of van. And then this is what our bank ledger account looks like after this transaction. So we have an opening balance, and the opening balance could be whatever. It could be a debit opening balance, credit opening balance, doesn't really matter. And then we debit bank $4,000. And then this is the disposal of van account. So we can see on the credit side, there's that entry and the cross-reference is bank of $4,000. Okay, now step 3A is to close the disposal of asset account. And in this case, there's a loss on disposal. So in this case, for this business, the proceeds they received from the disposal is less than the carrying value of that non-current asset. And when this happens, that means that the business has experienced a loss on disposal. And so when a loss occurs, we increase the loss on disposal of asset, which is an expense, and so we debit that to increase it, and we decrease the disposal of asset ledger account by crediting it. So here's an example. So it's the same example from before. So here's a quick question. I'll give you a couple minutes. So in this case, has the business had a profit or loss on disposal. So I'll just give you a couple of seconds to think about it. So was there a profit or a loss on the disposal? Okay, so hopefully you guys all finished your calculations and you should have found that, so the carrying value is cost minus accumulated depreciation. So in this example, to calculate carrying value, we do $25,000, which was the cost, minus $15,000, which was accumulated depreciation, and that gives us a carrying value of $10,000. And then proceeds is $4,000. And so then we do the difference between the proceeds and the carrying value, and in this case $10,000 is greater than $4,000, which means that the carrying value is greater than proceeds, and so a loss on disposal has occurred in this example. So hopefully that gives you a bit of an idea about how we calculate whether a loss or a profit occurs. It's the exact same process either way, so we just calculate the carrying value as cost minus accumulated depreciation, and then we compare the carrying value to the proceeds on disposal, and those proceeds could either be cash received from a sale or a trade in value. And then we compare the proceeds to the carrying value, whichever one is bigger, and then if the carrying value is greater than the proceeds value, then a loss has occurred. But if the proceeds value is greater than the carrying value of the asset, then a profit on disposal has occurred. So as I mentioned before, a loss occurs when the proceeds is less than its carrying value, and in order to record this loss, we need to increase or debit the loss on disposal of asset account and decrease or credit the disposal of asset account. So going back to our example, this is how we'd record that. So on 31st of December, we debit disposal of van $1,000 and credit, oh, in this case it was a profit, so we credit profit on disposal $1,000. And then this is what the disposal of van account looks like after that. And then if there was a profit, this is what the profit of disposal of van account looks like. Okay, and then step 3B is instead of receiving cash, the new non-current asset is debited. So this is if there's a trade-in of the non-current asset. So instead of selling the non-current asset and receiving a cash value in return of that sale, we have a trade-in of the non-current asset, which means that someone takes a non-current asset and then they give us a trade-in value for when the business, purchases a new non-current asset. And so in this case, we would increase the new asset by debiting and increase the disposal of asset by crediting. So here's another example. So we had a new van. We purchased a new van worth $30,000 by trading in the old van, which had a cost of $25,000, and we had a trade-in value of $1,000, and the accumulated depreciation of the old van was $15,000. So this is how we would record this. So first we have to transfer the carrying value, so we have to transfer the cost, and we have to transfer the accumulated depreciation of van. So on 31st of December, we'll debit disposal of van $25,000 and credit van $25,000 to transfer that cost of the van. And then we would debit accumulated depreciation of van $15,000 and credit disposal of van $15,000 to transfer the accumulated depreciation of the van. And then we would record the proceeds by debiting van $1,000 to show that that $1,000 is going towards the new van. And then we credit disposal of van $1,000 in order to show that we're transferring the proceeds amount to the disposal of van ledger account. And note how the van account is debited to represent the new van gained in the trade-in. So obviously the new van is worth $30,000. So the $1,000 is just part of the value of the new van, but it's going towards to represent the value of the new van that is gained in the trade-in and the purchase of the new van. And this is how we show the loss on disposal. So we had a loss of $9,000 because we calculate the carrying value of the van as $25,000 minus $15,000, which is $10,000, and the proceeds was only $1,000, and so we had a loss because the carrying value was greater than the proceeds of the van, and it was a loss of $9,000 because $10,000 minus $1,000 is $9,000. So that's a loss of $9,000 on the disposal of this van. And so we record that by debiting loss on disposal of van, which is an expense account, by $9,000 and crediting disposal of van $9,000 to show that that loss has occurred. And then once we've recorded the disposal, so after we record the loss, we finish recording the disposal of the old van, and once we finish that, we also need to record the purchase of the new van. And so we know that that new van had a cost of $30,000. However, we also know that we had a $1,000 trade-in value of the new van. And you can see earlier that we recorded this trade-in value by debiting van, which is going towards the value of the new van, $1,000. So when we're recording the purchase of the new van, we only have to debit van $29,000 because that's $30,000 minus that trade-in value. So it's only $29,000. And then we'll also debit GST clearing $3,000, which is the GST on the entire cost. And then we credit bank, this should be $32,000 because the total cost was $33,000 including GST. So we had van plus GST is $30,000 plus $3,000 GST, which is $33,000. So the entire amount for the new van is $33,000. $3,000 of that was GST and $30,000 of that was the value of the new van. However, we don't actually pay the entire $30,000 because we had that trade-in value. So the business is paying $33,000 minus $1,000 because the $1,000 was a trade-in value. So the business only pays $32,000 for that new van. And like I was saying before, so the carrying value is $10,000. Proceeds are $1,000, which means that a loss has occurred because carrying value was greater than proceeds. And it was a loss of 9,000 because 10,000 minus 1,000 is 9,000. And then the van is only increasing by 29,000 because 1,000 has already been recognized. Okay, and then once we've recorded the disposal of van, recorded the profit or the loss on the disposal of the non-current asset, we need to also report this profit or loss on disposal in the income statement of the business. So if a profit on loss of a non-current asset on disposal of a non-current asset occurs, then this profit goes under other revenues because it's a revenue earned by the business, but it's not directly related to inventory. So if a revenue is related to either the sale of inventory or just related to inventory in general, then it'll go in before the adjusted gross profit in the income statement. So any revenues related to sales goes under sales before gross profit, and then any other revenues related to inventory, such as inventory gain, goes under gross profit before adjusted gross profit. But this particular revenue, profit on disposal, is not directly related to inventory. Instead of being related to inventory, this revenue is related to the non-current assets of the business. And so because it's a revenue that isn't related to inventory, it goes under other revenues. So if you ever get a theory question in your exam, say for example, that asks why does profit on disposal of a non-current asset go under other revenues instead of being, before adjusted gross profit or before gross profit, that's all you have to say. So you just have to say the only revenues that are directly related to inventory, so revenue that either gets inventory into that is related to the sale of the inventory, such as cash sales, credit sales, sales returns, or it's revenue that is related to inventory but isn't directly related to sales, such as an inventory gain. So only revenues that are related to inventory go in the first half of the income statement. And by first half, I mean in the gross profit and adjusted gross profit section of the income statement, so before net profit. And because profit on disposal of a non-current asset is a revenue, but it's a revenue that is not related to inventory, it goes under other revenues. And that the same can be said of any other revenues that are listed under other revenues. So we could have, discount revenue, which is a revenue, but it isn't directly related to inventory. And same with interest revenue. So interest revenue is interest earned on, for example, a term deposit, and that is related to a term deposit. It's not related to inventory. And so because it's not related to inventory, it goes under other revenues instead of going in the first half of the income statement. And then a loss on disposal of a non-current asset goes under other expenses. And it's a very, very similar train of thought and reasoning for why it goes under other expenses instead of going, under cost of sales or before adjusted gross profit. So very, very similarly. Only expenses that are related to inventory, either related to the sale of inventory or related to inventory in general, go before adjusted gross profit. So expenses that are incurred to get inventory into a condition and location ready for sale go under cost of goods sold. So those are expenses that happen in order to get inventory ready for sale. So either get inventory into a condition ready for sale or to get inventory into a location ready for sale. And that is what goes under cost of goods sold. And then after gross profit, we have some other expenses. We have either an inventory loss and or an inventory write-down. And even though these two expenses aren't directly related to the sale of the inventory, whether we have an inventory loss or an inventory write-down isn't going to directly impact the sale of inventory, but it is still an expense incurred by the business that is generally related to the inventory of the business. And so that's why it goes before adjusted gross profit. So it's very, very similarly to revenues. Expenses only go before adjusted gross profit in the income statement or in the first half of the income statement if those expenses are related to either the sale of inventory or related to inventory in general. And so in other expenses, we have other expenses of the business that aren't related to inventory. So for example, rent, electricity, insurance. Those are all expenses that help keep the business running, but those expenses can't be directly linked to inventory. So obviously, the business does need to pay rent. For example, if they have, an office that they rent out for business proceedings. So if they rent out an office, they obviously need to pay rent in order to use that office building. But that rent paid doesn't directly relate to inventory of the business. And obviously, when we're in accounting, Unit 3 and 4 accounting, we primarily deal with businesses that purchase inventory, mark up the inventory, and sell the inventory. So businesses where inventory is that business's main source of revenue. And so because inventory is the main source of revenue, almost all of our reports, and especially our income statement report, we're reporting under the assumption and, basically relating everything back to inventory because that's the business's main source of revenue. And so that's why in the order of the income statement, we have expenses and revenues that are related to inventory first in the income statement because those are kind of the most important revenues and expenses because those are revenues and expenses related to the business's main source of revenue. And then after we have those really important revenues and expenses that are related to the sale of inventory and related to inventory, then we have other revenues and other expenses because those revenues and expenses, those other revenues and other expenses are still really important to the business. They help the business run. They contribute to the day-to-day trading activities of the business. For example, if the business earns interest revenue, that's some extra cash that the business has that is going to help it in its day-to-day tradings. Or, paying electricity bills is going to, affect the day-to-day activities of the business. The business will have to put cash aside to pay those electricity bills. So it does impact the business and it does impact the day-to-day trading of the business, but those revenues and expenses are not directly linked to inventory, and inventory is the main source of revenue of a business. So that's why profit on disposal of a non-current asset goes under other revenues and loss on disposal of a non-current asset goes under other expenses. And that goes for not just accounting for non-current assets and profit or loss on disposal, it goes for any revenues and any expenses. And that is the backbone of how and why we order the income statement. And it's really, really important that you understand that, because um, that is a theory question that they could ask you. Why does this revenue go here on the income statement? Or why does this expense go here on the income statement? And you really need to have a good understanding of the order of the income statement. It's not just memorizing the order, knowing it's cash sales, credit sales, less sales returns, less cost of goods sold, gross profit, less inventory loss, less inventory write down, adjusted gross profit, add other revenues, less other expenses, net profit or loss. It's not just knowing that order, it's also understanding that order and understanding why that order is the way that it is. Why does sales go first? Why does cost of sales go first? Why do we have adjusted gross profit? Why do we have, gross profit, then inventory loss, inventory gain, inventory write down, adjusted gross profit? Why can't inventory loss or inventory write down go in other expenses? Or why can't inventory gain go in other revenues? And a lot of accounting students don't fully understand that. And it's really, really important that you do. So basically, to simplify all of that, we have in the income statement, first and foremost in the income statement, we have revenues and expenses that are related to sales, sales of revenue, sale of revenue, because selling revenue is the business's main source of income. So it's the most important revenues and expenses related to the sale. So that includes cash sales, which is a revenue, credit sales, which is a revenue, and sales returns, which is a negative revenue account that is directly related to sales. And then we have less cost of goods sold. And cost of goods sold is a title, and under cost of goods sold, we have all expenses that were incurred to get inventory into a condition or location ready for sale. So all expenses that were incurred to get to get inventory ready for sale. So that could include cost of sales, freight in, anything like that. For example, if the business sells jewelry and they sell engraved jewelry, and so they buy jewelry from a supplier and then they pay an expense to get that jewelry engraved, and then they sell it, that engraving of the jewelry is an expense incurred to get the jewelry into a condition ready for sale. Freight in is an expense incurred to get the jewelry into a location ready for sale, because obviously, we need the jewelry or the inventory, whatever inventory the business sells, we need that inventory to get to the business. And so freight in just means the expense, kind of like a shipping cost, kind of similar to a shipping cost, to get the inventory to the business. So we have sales, sales returns, cost of goods sold. Those are the most important revenue and expenses because they're directly related to the sale of inventory. Then we have gross profit, which is just a gross profit calculated based on the sales. Then we have any other revenues or expenses related to inventory. And they might not be related to sales, but they're still related to inventory. And because inventory is the business's main source of income, these expenses and revenues are still important. That's why they go first. So we have either either an inventory loss or an inventory gain, or an inventory write down. And then we have adjusted gross profit. And then after adjusted gross profit, it's any other revenues and any other expenses that were earned or incurred in that reporting period that impacted the trading of the business, the trading activities. So, if they've earned a discount revenue, if they've earned interest revenue, if they've earned a profit on disposal of a non-current asset, then that would go under other revenues. Other expenses, rent, electricity, loss on disposal of non-current asset, anything like that, depreciation as well. So hopefully that makes sense. I know I kind of rambled for a little bit, but it is super, super important that you understand that and you realize that, it's not just a random order. it's actually ordered that way for a reason. Okay, moving on. So, um, a loss and a profit on disposal doesn't just happen for no reason. It's actually linked to how the business calculates its depreciation. So, when a loss on disposal occurs, that means that the business has under depreciated that non current asset. So, what that means is they haven't allocated enough depreciation to the non current asset. So, the asset has not been depreciated enough, which means that the carrying value is higher than it should be. So, when a loss or a profit occurs, it means that the carrying value of the business is wrong. And because the carrying value is wrong, it means that depreciation has been calculated incorrectly. And so under depreciation happens for a number of reasons. So you have to remember when you were learning about depreciation, depreciation is calculated purely based on estimates and estimations. So we estimate the residual value, we estimate the useful life. The only thing that we don't estimate when we're calculating depreciation is the cost, because obviously we have a source document to back that up. Because when we purchase, for example, if you purchase a van, then we have the receipt or invoice that we got when we purchased that van that shows us this is how much that van was purchased for, the purchase price or the cost. So, other than cost, every other value that we use to calculate depreciation is estimated. There are calculations that you can use in order to kind of get that estimation, but at the end of the day, there isn't any source documents to back up the residual value or to back up the useful life of the non-current asset. And those are two very important values that we use when we're calculating depreciation. So if those estimations are wrong, then depreciation will be calculated wrong. And unfortunately, there's not much that you can do unless you're a time traveler and you can go into the future and know for sure how much the residual value of that asset is and how long the business uses that asset. Unless you can 100% know the future, you can't have a 100% accurate estimation of depreciation. So that's why more often than not, depreciation is wrong. Obviously that means, that doesn't mean that businesses can just, calculate depreciation however they want it to, if I'm a business owner, I can't just say, oh, well, my depreciation is going to be inaccurate anyway, so I might as well just calculate depreciation a certain way. No, you can't do that. You still have to be as accurate as possible. And, you can the business can consult their accountant, or, they can get multiple opinions of what other people or other accountants think the residual value and useful life should be. So they do have to try and be as accurate as possible, but nothing is ever 100% accurate with estimation and with depreciation. And there's a number of things that can cause underdepreciation. So, like I said, either incorrect estimations or the asset might have been damaged. So, for example, if the business purchases a van and they're expecting to use the van for 3 years, but then in the second year of use, the van has a car accident and it gets damaged. So that's going to have two effects. First of all, the business isn't going to be able to use that van as long as they could have, because now that van has been damaged, the business might have to purchase a newer van earlier than they were expecting because of that happening. And second of all, that van is now going to have a smaller residual value, because obviously if you're selling a damaged van or a van that has just got into a car accident, you're not going to get as high of a sale amount. So if we're trying to sell a damaged van, we're not going to get as much money as if we were selling an undamaged van. So The other thing is damage to the asset affects both the residual value and the useful life of the asset. Um, so that's the other thing to keep in mind. And, obviously that isn't necessarily an issue with the estimation of depreciation. In that case, that's an issue with, it was an accident. Car accidents happen. There's not much you can do to predict it or to prevent it, but it does affect the residual value and useful life of that non-current asset. On the other hand, if there's a profit on disposal, then this happens because of over depreciation. That means that the business calculated too much depreciation, more depreciation than they should have. And so the carrying value is lower than it should be. And this has two explanations. So once again, it may have incorrect estimations of the residual value or the useful life. They may have underestimated the residual value or the useful life. Or another explanation is that non-current asset is in a better condition than what was expected. So say if, for example, you have a van and you expect to have that van for 5 years, and after 5 years you expect the van to be pretty worn down. But during that 5 years, you regularly take that van to, the car dealership. You take really good care of the van. You drive carefully, you don't brake hard, and so the van is in really, really good condition after those 5 years. And it's in better condition than what you were expecting, then that probably, most likely, the residual value of that van is going to be higher than what you were expecting. So, to summarize that, basically, with under depreciation or over depreciation, there are two explanations. The first explanation is that the business incorrectly estimated the residual value and useful life, and they either overestimated the residual value or useful life, or they underestimated the residual value or useful life. And the second explanation to incorrect depreciation is that the condition of the non-current asset was impacted in some way. So either it was impacted in a negative way, so it was damaged, say think of like what I was saying before, a van getting into a car accident, or that condition is better than what you were expecting. So basically you just took really, really good care of that non-current asset, which worked out in your favor. And when we are explaining reasons, so a really common question that VCAR can ask you in the exam is they'll get you to, record the disposal, calculate either the profit or loss, and they'll ask you, why has the profit on disposal occurred? Or why has the loss on disposal occurred? And you can't just say, the loss occurred because of under depreciation. You have to also explain why that under depreciation occurred. And sometimes in the question they tell you that, the question could say, the business had a van and the van was damaged. Or they could say, the business, the business had a computer and the computer, someone accidentally spilled water on the computer and so it got damaged. Sometimes it does tell you in the question, but if it doesn't tell you, you would just say, a loss has occurred because there was under depreciation. And then you would say, this under depreciation either happened because of overestimating the residual value or useful life, or there might have been damage to the non-current asset during its use by the business. So if that makes sense. So always be super, super specific when explaining the reasons for a profit or loss on disposal. And if you're going to say under depreciation, explain why. If you're going to say over depreciation, explain why. And second of all, try to, as best as you can, try to link it to the information that's given in the question. And specifically how with accounting, in the exam, the questions, they have a block of writing, like a mini paragraph of writing, and then the question. And a lot of the time, students just completely skip that paragraph of writing because, it's just an introduction to the question. It's just the context of the question. But a lot of the time, they hide really, really useful details in these paragraphs. So, in the paragraph before the question and in the additional information under the question. Those are the two places where VCA love to hide details that could really, really help with your theory responses, your theory answers. So, always read that paragraph and read the additional information. And you could either do this in the reading time or as you go. I would recommend doing it in your reading time. You have reading time in your exam, so you might as well use it. Try to read all of that context in your reading time, because then if you go back to question 10 during the exam, you'll remember, oh my god, I remember during reading time they said that the van was damaged, or I remember during reading time they said that the depreciation was calculated wrong. They might have mentioned that. So always read that information. Don't just skip over it. And when you're doing your theory responses, try to link that contextual background and that extra information that they give you, try to link that in your responses. So here's an example. So we have a non-current asset, which in this case is a photocopier system, which is going to be depreciated at a rate of 30% per annum using the reducing balance method. And then we have the accountant has reached out to the business and said that the business is planning to use the reducing balance method, but the accountant recommends that the business uses a straight line method because this will provide a more appropriate depreciation expense each year. And so this is a common theory question that you might be asked. It just says, with reference to the appropriate accounting principles and qualitative characteristics, discuss the factors that the accountant would have considered when making this recommendation. So, question 2, think about which depreciation method the business should use. And I'll give you a minute to think about it. Okay, so we'll go through the question now. So here are the points that you could have used in your response. So not only just deciding which depreciation method, but also, supporting that decision with reasoning. So first of all, depreciation is allocated so that an accurate profit can be determined for the reporting period. It has to match the revenue earned by the asset. So the most important thing that must be considered when choosing a method of depreciation is the revenue earning pattern of the non-current asset. So, if the photocopier is expected to earn more revenue in the earlier years or the start of its useful life, then the reducing balance method should be used. However, if the photocopier is expected to earn revenue consistently and be just as useful at the start of its life as it is at the end, so be very consistent, then the straight line method should be used. And by selecting the most appropriate method, this would ensure that there's enough depreciation expense to match the revenue earning pattern. The business has already used the reducing balance method, and so the business might want to support consistency and make sure that the reports are comparable, which supports comparability, because obviously if we've been using a particular method, then we want to keep using that method so that we can still compare future reports to previous reports, because when there's the same method used, it's easier to compare reports, which allows for a valid comparison of performance and a comparison of reports in different periods. And relevance would support using the reducing balance method, since writing off more of the cost of the asset would ensure that the value is not potentially overstated. Okay, that was part 1 of our content. So I'll actually give you guys a 5-minute break, and then we'll come back for part 2, which is budgeting. Okay, so we'll get started with the next section of our content for today. So, budgeting is the process of preparing future reports in order to predict the financial impact of future transactions. And this process assists planning by predicting likely future events, um, and it aids decision making by providing a benchmark against which actual performance can be compared. And according to the study design, we need to be familiar with three budgeted reports, which is the budgeted cash flow statement, the budgeted income statement, and the budgeted balance sheet. Our budgeted sales are particularly important since sales are a business's main source of income. So, like I was saying before when I was talking about the order of the income statement, inventory is the most important asset that a business owns, its main source of income, and sales of inventory is the most important revenue that a business earns. So, budgeted sales is the most important budgeted transaction that we predict because it's the business's main source of income and we want the most accurate prediction of that. Estimating sales helps us to estimate cost of sales and other expenses, and the number of sales will also impact how much inventory is purchased in the next period. There are 4 steps to budgeting. Step 1 is to prepare budgeted reports to predict future transactions. Step 2 is for actual reports to be prepared when the actual transactions occur, so when that period actually happens. And then step 3 is to prepare variance reports to compare what we predicted to what actually happened so we can highlight any differences and identify problem areas in the business's performance. Our budgeted cash flow statement compares future operating, investing, and financing cash flows, inflows, and outflows. The operating activity section of the budgeted cash flow statement will be the predicted cash inflows less the cash outflows related to the future day-to-day trading activities of the business. If the budgeted cash flow statement shows predicted negative operations, then the business should aim to increase cash flows and decrease cash flows in future reporting periods. And if the owner is aware of an expected negative operations, then they should really be aiming to change that. So, a lot of times accounting students just assume that budgeting is just predicting what's going to happen and then seeing if what happens is the same as what we predicted, but that isn't actually the case. If the business is predicting a negative outcome, for example, in the cash flow statement, if they're predicting a negative net balance of bank balance and negative bank balance, or if they're predicting in the budgeted income statement a loss, or if they're predicting in the balance sheet, a lot of new liabilities, or not a high valuation of assets, then the business isn't just going to sit by and let those negative outcomes happen. The business and the business owner should really be trying everything that they can to stop those negative outcomes from happening. And if, on the other hand, if the business is predicting a positive outcome, for example, they're predicting a positive bank balance or a net profit, then the business should be taking advantage of that predicted positive outcome. For example, if it's predicted that the business will have a whole bunch of cash lying around, the business might want to purchase a non-current asset or put a term deposit in that future period. So, budgeting isn't just, oh, I'm going to make a prediction and I'm going to see whether my prediction is right. It's, I'm going to make a prediction. If it's a negative prediction, I'm going to try and change that prediction. And if it's a positive prediction, I'm going to try and take advantage of that positive prediction. So hopefully that makes sense. Our budgeted cash flow statement also includes future investing activities and financing activities section. And obviously, investing activities is cash inflows from the sale or cash sale of a non-current asset, and cash outflows um, uh, from the cash sale of a non-current asset. And financing activities is, inflows and outflows related to transactions that change the financial structure of the business, which includes transactions related to loans, contributions, loan repayments, and drawings. We use our budgeted cash flow statement to plan and prepare in advance. So if the business is expecting a cash surplus or, extra cash basically, then the business owner could decide to use that extra cash to expand the business, pay off debts, make drawings, or purchase a new non-current asset. Or, like I was saying before, put money away in a term deposit to earn interest. If the business is expecting a cash deficit, then the business owner could decide to delay the purchase of a non-current asset. So, for example, if, say, in November, I'm the business owner and I'm planning that in November the business wants to purchase a new van because we have an old van and it's getting kind of old and damaged and we need a new one. So we're planning to buy a new one in November. But according to my budgeted reports, the business is expected to have a cash deficit in November. Then I might say, you know what, maybe we shouldn't buy the new van in that period. Maybe we should wait a little bit and then purchase that new van when we're in a little bit of a better cash position as a business. So yeah, they could decide to delay purchases of non-current assets, reduce cash payments as much as possible. Obviously this might not be possible, but if you can, then try to reduce your cash expenses and payments. They could make cash contributions from the owner. They could organize a bank overdraft, or they could, aim to reduce expenses. And in really, really, worst case scenarios, if they really, really have not enough cash, they could take out a loan. And we also use the budgeted cash flow statement for assessing other areas as well. Okay, moving on. Our budgeted income statement shows the expected revenues and expenses and thus the expected profit or loss. It's important that you're aware of which items affect cash but not profit and which items affect profit but not cash. And that goes back to the topic that you did earlier this year called profit versus cash. So understanding that profit and cash are separate performance areas of the business. There are some transactions that will only affect cash and not profit, some transactions that will only affect profit and not cash, and some transactions that will affect both but by different amounts. Our budgeted income statement allows for us to plan for future requirements and provides a standard against which actual profit performance can be compared. The budgeted balance sheet helps the business predict its financial position at any particular date in the future. So note that with the income statement and cash flow statement, that can be prepared for future periods, but a budgeted balance sheet can only be prepared for one date in the future. It can't be prepared for a period, it's only one date because the balance sheet is always just as at a single date. It's never a period. And we can use information from the budgeted balance sheet to plan when to replace a non-current asset, when to repay a loan, and the amount of drawings for the next period. The budgeted balance sheet allows indicators to be calculated and provides a standard against which actual performance can be compared. So we have a practice question here. So basically, the key to budgeting is, like I was saying earlier, identifying whether a transaction affects cash, profit, both, or neither. And the best way to do this, I would say, is to actually take, colored pens or highlighters, and in your exam, use a color coordinated system. So, for example, you can do green for transactions that affect cash, yellow for transactions that affect profit, um, stuff like that. Or you can even just like take your pen and write cash, profit, both, neither next to each transaction. So here's an example of a bunch of transactions that you can kind of go through and see. Okay, so here's a practice question. So have a read of this question and try to decide whether there has been a cash surplus or deficit in this question. And I'll give you about a minute to answer. Okay, so in this case, there has been an overall cash surplus of $20,000. Okay, so when we're answering theory questions, there are a few questions that you can ask yourself before you attempt to answer. So, what's happening in the big picture? Why did that overall result happen? Why was there an inflow outflow? Why does this transaction affect cash but not profit? Why was there a net profit or a net loss? Why was there a surplus or deficit? Stuff like that. For example, in the balance sheet, why was bank a liability instead of an asset? If there was a bank overdraft. And then, is there any additional information we can use? So, like I was saying earlier, really reading the paragraph of background context, reading the additional information, and thinking to yourself, is any of this useful in my theory response? So, for example, a really, really good example that I can think of is there was this question one year that was talking about a business that sells toys, and it showed a report from the business that had really, really high sales for this particular reporting period. And then the theory question was, it was a discussed question, and one point that you could have talked about was it was December. And obviously in December it's Christmas time. And so a toy store in December is going to have really, really high sales because of Christmas. Everyone will be buying toys to give as presents for their, children and relatives. And that's not something that would be really, really obvious to everyone, and it's not something that they're just gonna give you. It's not gonna outright say that, but that comes down to thinking outside of the box and trying to link the additional information in any way that you can think of. And examiners really, really like when students do that, when they use a detail given in the background or in the additional information and they link it to the question in a way that is thinking outside of the box or is in a way that everyone would think of. Think about the information that's missing from the question. What don't we have? Do we need to find that information? Is that information important? Is that going to affect, for example, if it's asking you to figure out which depreciation method is going to be used, but it doesn't tell you the revenue earning pattern, you would say, we don't know the revenue earning pattern, and that's the most important piece of information. We need to pick a depreciation method. So we need to know whether it has an even revenue earning pattern or whether that asset is more valuable for revenue earning at the start versus at the end. Um, what information, what are the limitations of the information? Um, for example, with financial indicators, each indicator has its own limitations. It has its strengths, but it also has limitations, and you need to really, really know that. Non-financial information we can consider, so like I was saying before, Christmas time would be non-financial information. It could also be customer satisfaction, customer service, any of that. And are there any relevant ethical considerations? Even if a question does not outright say discuss the ethical implications, you can still mention ethical considerations. For example, if a question is saying which depreciation method should be used, and if the business owner wants to use a depreciation method that is wrong, it's not the best depreciation method that they want to use, you can mention that knowing that this depreciation method should be used, but still knowingly choosing the other depreciation method is a breach of ethical considerations, because it means that you're misrepresenting your business in your reports and you're not being honest to your shareholders, to financial institutions, stuff like that. So here's another exam question. And so it's basically asking us to describe the variances and provide a possible reason for each variance. So we would say, the favorable variance in cash sales may be the result of extra money on advertising. You could have increased your selling prices, anything like that. Favorable variance in receipts from accounts receivable might be because you have better collection methods, you have better management of accounts receivable. You sent out prompt invoices, stuff like that. And a favorable variance in payments to accounts payable means that the business may have used its full credit terms and kept cash for longer. Here's another question which is talking about the schedule of receipts from accounts receivable, and you do need to know how to prepare a schedule of receipts from accounts receivable for the exam. Okay, and then another thing that's really important is account reconstruction, which involves using ledger accounts to determine figures that are required for the preparation of reports. And this is a 3-step process. You need to first of all identify the expected ledger account entries, and there'll be different expected entries for the different types of ledger accounts. Match these expected entries with the figures that we know, or the amounts that we know, and then using these figures to determine the unknown figures, or what's not given to us. You need to know the ledger account templates, which is basically just the expected entries. So knowing, for example, in the bank ledger account, which transactions are expected to go in the debit side, which transactions are expected to go in the credit side. So this is the ledger template for the accounts receivable account. You can see we have the opening balance, which is always a debit opening balance because accounts receivable is an asset. We have, sales GST on the debit side, which is basically where we have a credit sale occurring. And then on the credit side, we have a receipt from accounts receivable, which the cross-reference is just bank, discount expense, sales return if a customer purchases on credit. We make a credit sale and then the customer returns the inventory. And we also have allowance for doubtful debts. And then the closing balance, of course. And then most of the time, with the accounts receivable reconstruction of the accounts receivable ledger account, the missing figure that you'll be finding is receipts from accounts receivable. So this figure right here. So it'll tell you the opening balance, the sales, the discount expense, sales return, allowance for doubtful debts, and it won't give you the bank. And so you're going to have to enter all of the transactions, and then based on that, calculate what the receipts from accounts receivable amount was. Similar for accounts payable, we have our opening balance on the credit side, we have a credit purchase, payments to accounts payable, discount revenue, and a purchase return and the closing balance. And then most of the time you'll be finding payments to accounts payable. So it'll give you all of these figures and it won't give you the payment to accounts payable figure. And then you'll have to enter everything and calculate what that payment to accounts payable amount is. Same with inventory. So we have all of the expected transactions, and then what we'll be trying to find is either cash or credit sales or unearned sales revenue. And most of the time with this, we'll be trying to find cost of sales. GST clearing, we have GST clearing reconstruction is a little bit tricky. So really make sure that you know the transactions, the expected transactions, because with GST clearing, sometimes the cross references are a bit confusing because it's, bank could be GST received, it could be a GST refund. Bank on the debit side could be GST paid, or it could be GST settlement. Stuff like that. If the cost reference is accounts receivable, it could be a sales return, but it could also be bad debts, stuff like that. So just really knowing the transactions. This is the template for the capital account for when we're reconstructing that. This is the template for the disposal of non-current asset account, and it is possible that the question will ask you to reconstruct the disposal of non-current asset account, and similarly with the allowance for doubtful debts account. So here's an example where the balance of the accounts receivable was $15,000, credit sales was $110,000, sales returns was $1,000, discount expense $500, and there was $2,000 worth of bad debts. And the closing balance at the end of the month was $50,000. And so we need to enter all of that information. So we have the opening balance, $15,000. Credit sales, $110,000. Discount expense, $500. Sales return, $1,100. Allowance for doubtful debts, or the bad debts, $2,200. And the closing balance, $50,000. And they didn't give us the receipts from accounts receivable. But once we enter all of that, we can then calculate the receipts from accounts receivable, which in this case was $71,200. With variance reports, we are comparing actual versus budgeted figures, classifying the differences as either favorable, unfavorable, or neither, and that's strictly from a financial standpoint. So obviously, for example, in a budgeted income statement, say for example, if we were expecting advertising expense of $500, but instead it was advertising expense of $1,000. Now, just looking at it from a purely financial standpoint, that is an unfavorable difference because we were only expecting to pay $500, but we actually ended up paying $1,000, which is more than what we were expecting to pay. However, thinking of it from a non-financial standpoint, more advertising is actually good for the business because the more ads you have out there, the more potential customers you're bringing in. And so maybe paying more for advertising means that we have higher sales for that period. But obviously, we only look at variance reports from a financial standpoint, so we don't think about non-financial information. So in the cash flow statement, when the actual inflow is larger than the budgeted inflow, then this is a favorable variance. When the actual inflow is smaller than the budgeted inflow, this is an unfavorable variance. When the actual outflow is smaller than the budgeted outflow, this is a favorable variance. And when actual outflow is larger than budgeted outflow, this is an unfavorable variance. And we use the cash flow statement variance report to plan for future budgeting and aid decision making. So for example, if you ended up with way more sales returns than what you were expecting, then this tells you that maybe your customer service isn't the best, maybe your inventory product quality isn't the best, and you would try to fix that, or you would fix that area of business performance. And like I was saying, so down here, there's a difference between something that's favorable financially and something that's favorable for the business. Like I was saying earlier, paying more for advertising. Financially, that is unfavorable, but for the business, it is favorable because more advertising means more customers. And here's an example of the cash budget variance report. So you can see we have the budgeted figures, the actual figures, the difference between these figures, and whether that is favorable or unfavorable. And if we have a dash, that just means that it was the same, which means that there's no variance. Okay, so let's have a look at the variance in wages paid and whether this is favorable or unfavorable. and it was unfavorable. Sorry, payments to accounts payable, not wages, and it was unfavorable. Okay, income statement variance report compares actual and budgeted revenues and expenses. When the actual revenue is bigger than the budgeted revenue, this is favorable. When the actual revenue is smaller, it's unfavorable. When the expense is smaller, it's favorable. And when the expense is larger, it's unfavorable. And we can use the income statement variance report to plan the next budget and aid decision making. Here's another variance report example. And here's an example exam question where it's showing an extract from the complete variance report, and we need to identify possible reasons for the variances for cost of sales and depreciation. So why is cost of sales more than what was expected? I'll give you a minute. So basically, with cost of sales, the business sold more than what was expected, and so cost of sales would be more than what was expected because sales and cost of sales is kind of like a ratio. If sales goes up, cost of sales goes up. If sales goes down, cost of sales goes down. So actually, even though a higher cost of sales is considered an unfavorable variance financially, it's actually good for the business because more cost of sales means more sales, which means that the business received higher revenue. And depreciation being um, uh, less than what was expected basically just means that it occurred because the business sold a vehicle without replacing it, which means that the amount of non-current assets went down, which decreases the amount of depreciation expense for the period. Okay, so thinking about this variance in payments to accounts payable, is this favorable or unfavorable? So the budgeted was more than the actual payments. So financially speaking, it was a favorable variance because it was more cash generated than what was predicted. And this could have been the result of basically the business paid less to the supplier than what was expected, which basically means that the business may have taken full advantage of the credit terms offered by the supplier and kept cash in the business for longer. And the final step in the accounting process is to provide advice by analyzing and interpreting financial data, including interpreting variance reports, interpreting budget reports, and interpreting actual reports. And one area of performance that we can analyze and provide advice for is profitability, which is the ability of the business to earn profit compared to a base. This is dependent on the business's ability to earn revenue and control expenses, and it's measured using trends, variances, benchmarks, and the most important one, indicators. And it's really, really important. We're about to go through the indicators, but I just want to stress, I cannot stress enough how important it is that you memorize all of the indicators, all of the names, all of the formulas, and what each indicator shows, what situations we would use each indicators, all of that. Profitability indicators includes return on owner's investment, return on assets, asset turnover, net profit margin, and gross profit margin. So you really need to know all of them. So return on owner's investment assesses how effectively the business has used the owner's capital to earn profit. It measures profit earned per dollar of capital invested by the business. It can be compared against previous periods budgeted and the industry average. And it's from the perspective of an investor, so it should be comparable to other investments. Debt ratio is a stability indicator that measures the percentage of the firm's assets that are funded by liabilities, showing the extent that the business relies on debts compared to capital, or relies on liabilities compared to capital. It's directly linked to the return on asset. If there's a high debt ratio, then it means that the firm relies a lot on borrowed funds, which results in a high return on investment. But if there's a low debt ratio, it means that the firm is not relying on borrowed funds, which results in a lower return on investment. So basically, the more debt a business has, the higher return on investment. Because if we have higher liabilities, that means that there's less capital contributed, which means that compared to the amount contributed, the owner is earning more, getting more on the owner's investment. There's a higher return on the owner's investment. So here's an example where we have to compare the debt ratio and return on owner's investment of two businesses. So why does Andre have a higher return on investment? Basically, because Andre has a higher debt ratio, which results in a higher return on owner's investment. So it's kind of like a double-edged sword. Obviously, a high return on owner's investment is a good thing because it means the owner is earning more compared to how much that owner put into the business. However, if there's a higher return on owner's investment, there's also a high debt ratio, and a high debt ratio means the business is at greater risk of collapsing financially. The business has a lot of debt. It has way more debt compared to the other business, Mustafa's music. So basically that means Andre is relying way more on debt and liabilities, which means that if the business doesn't do well in a period, or it doesn't earn as much cash as what was expected, or for whatever reason it loses a lot of customers, it's not going to have enough cash to pay off those debts. So the business, and not being able to pay off debts might result in the business going bankrupt and collapsing financially. Okay, return on assets assesses how effectively the firm has used its assets to earn a profit, and it measures profit earned per dollar of assets the business controls. It can be compared against previous periods, budgeted figures, and the industry average, and it's from the perspective of the manager, or from the perspective of the business owner. Return on investment is always greater than return on assets unless the business has absolutely no liabilities. So it's 100% funded by capital contributions, and there's absolutely no liabilities, no loans, no liabilities, which is a very, very rare that a business would have absolutely no liabilities. At the very least, they would have GST. So here's another example where we have two return on assets compared to the average total assets. Asset turnover is an indicator which assesses how productively the business has used its assets to earn revenue. So basically, compared to how many assets the business currently has on hand, how much revenue is being earned. If they have a whole bunch of assets, but they're not actually earning that much revenue, that indicates that the business is not using its assets to the full capability that the assets can be used. Because the whole point of owning assets as a business, the whole entire point of purchasing assets and keeping them on hand is that those assets will help the business to earn revenue. So if you have a whole heap of assets on hand as a business, but you're actually not earning as much revenue, then that is telling you as the business owner that you can use your assets better to earn revenue. Or on the other hand, if you have a really low amount of assets, but you're still earning a lot of revenue, that is telling you as the business owner that you are effectively using your assets to earn revenue. And based on asset turnover, the business owner can decide to purchase new assets, sell assets that aren't being productive. For example, if you just have an old van that broke down that you haven't sold yet, but you can't use that van to help you earn revenue, it's just sitting there, it's not being productive. And so businesses should be selling unproductive assets. the business could try to improve the efficiency of assets. For example, if you have a van that has been damaged and so it doesn't, run as well, then you might get that van fixed to increase the efficiency of that van. And yeah. Net profit margin indicates which, basically, it indicates how well the business controls its expenses, total expenses, how well the business controls all of its expenses. And it does this by calculating the percentage of sales that is returned as net profit. So basically, out of the total sales earned from the business, how much of that sales is actually retained as net profit. So how much is retained as profit versus how much is going towards expenses. And if net profit margin is higher, then this is favorable because it indicates that the business has managed to retain a lot of its sales as profit and it has good expense control. But if the business's net profit margin is lower, this indicates that the business has bad expense control and it's not retaining as much of its sales as profit. Okay, so you really need to understand the relationships between the different financial indicators. So, how is net sales related to asset turnover related to return on assets? So in this case, we have these three financial indicators for 2025 versus 2026. And the question is, why has return on assets decreased despite an increase in asset turnover? Basically, if asset turnover increases but return on asset decreases, this means that net profit margin must have decreased, which means that expense control has been worsened. So basically, if we see an increase in asset turnover, but we see a decrease in return on asset, that means that the business has gotten worse at controlling its expenses. And because of that, net profit margin must have also decreased. If we have the opposite effect where asset turnover has decreased but return on assets has increased, this means that net profit margin has increased because the business's expense control improved. So if a question provides information that includes so we have return on assets, net profit margin, and asset turnover. If they include two of these three, then you need to know this relationship and understand why this relationship occurs and refer to the other indicator that isn't provided. So in this case, net profit margin wasn't provided, but they did provide asset turnover and return on assets. And so you need to be able to analyze those changes to understand how changes in asset turnover and return on assets indicates the change in net profit margin. Gross profit margin assesses the average markup of the business by determining the percentage of sales retained as gross profit. And a higher gross profit margin shows that the business has a higher average markup, which means that it's a good thing to have a higher gross profit margin because it means that you're earning more for compared to how much you purchased your inventory for. However, markup is a very tricky thing because it's good to have a higher markup and to earn more for your inventory, but sometimes if you increase your markup by too much, then you might actually, lose a lot of customers because, if you have loyal customers who've been paying, say, $10 for each item of inventory, and then one day they come into your store and the inventory is $20, they're going to say, why would I continue to shop here and pay double the amount that I was paying previously when I can just go find a cheaper store? So it's kind of tricky to talk about markup, and in your theory questions you need to be able to understand those intricacies and understand that markup and gross profit margin is not simple. It's not just high markup is good, because sometimes if your markup is too high, you could lose customers. Another way to increase markup without changing selling prices is to switch to a cheaper supplier. So for example, if we're selling items at $10 per item, but we're purchasing the item for $5. And then if I'm the business owner and then I see, oh, there's a cheaper supplier that's only selling the inventory for $2.50 instead of $5, and that would increase our business's markup, and we don't even have to change our selling prices. So we can still, keep our customers, not repel our customers, but we can still increase our markup. However, you need to keep in mind that sometimes a cheaper supplier might mean lower quality inventory. So, if I'm a customer and I come into the store that I always shop at, and for example, say if the store sells calculators, and then, if I'm a teacher and every year I buy calculators for all my students, and so one year I come in to buy the calculators, and the calculators are a much lower quality. They break really easily. They don't turn on. They switch off unexpectedly. They're just bad quality calculators. Then I'm probably not going to go back to that store in the future for when I need calculators. And the other thing is you need to keep in mind ethical considerations. If we're a business that sells calculators and we find a supplier that can sell the calculators to us for $2.50, that is kind of a red flag as a business owner, because that might mean that that supplier is using child labor. They're not paying their workers enough. They don't have a safe working environment. So it's your responsibility as a business owner. Obviously, you're not a business owner, but if you are a business owner, it's your responsibility to look into all of your suppliers and ensure that you are only purchasing from ethical suppliers. So that's what I was saying earlier. Sometimes a question might not necessarily ask you about ethical considerations, but you still need to consider them and you still need to talk about them in your responses. So when we express all of the items in the income statement as a percentage of sales revenue, this is called a vertical analysis of the income statement. And this is just a way of visualizing that net profit margin and gross profit margin and really understanding, for example, there might be one expense that is really eating up a large percentage of sales. And you might say, how can I reduce that expense? And the way we can improve profitability is by increasing our revenue earning abilities, by changing selling price and using marketing more effectively, managing inventory better, and move to a better location. Okay, non-financial indicators for profitability. Basically, when we use profitability indicators, there are limitations. So first of all, reports use historical data, and so calculating indicators based on historical data might not be accurate, and it might not accurately reflect future performance. They rely on averages, which isn't as accurate as you could be, and different businesses can use different methods, which means that it's not easy to be compared and it doesn't support comparability. And reports also contain limited information. Not all information about a business's proceedings is included in the reports. And there is non-financial information that you need to consider in your responses as well. And basically the rule is, if a business includes non-financial information, in the paragraph of background context or in the additional information, try to work it into your answers in some way. And even if you can't immediately see a link between non-financial information and a theory response, try to think outside of the box. Try to think, how does this relate to this area of performance? So we have two businesses here. They have the exact same return on assets, but they have very different return on owner's investment. And basically, how can this happen? And basically, return on assets might be the same because both businesses effectively use their assets to generate profit, but the business's reliance on liabilities might be different. So business A relies more on owner's capital, so they have a lower return on investment, and business B relies more on liabilities and less on owner's capital, and so they have a higher debt ratio and a higher return on investment. Okay, moving on to liquidity indicators. So with liquidity indicators, there are two different categories. We have level of liquidity indicators and speed of liquidity indicators. Level of liquidity indicators include working capital ratio, quick asset ratio, cash flow cover, and speed of liquidity includes inventory turnover, accounts receivable turnover, and accounts payable turnover. So the easiest way to remember this is speed of liquidity are the turnovers: inventory turnover, accounts receivable turnover, and accounts payable turnover. And then the other three liquidity indicators, which is working capital ratio, quick asset ratio, and cash flow cover, are level of liquidity indicators. And just a reminder, liquidity is the ability of the business to meet its short-term debts as they fall due. So basically, the ability of the business to pay its liabilities and pay its debts in the short term, so in day-to-day activities. So, working capital ratio assesses the ability of the business to meet its short-term debts by measuring the ratio of current assets to current liabilities. So, working capital ratio should be at least 1:1, which means that the firm has enough current assets to cover current liabilities. If it's less than 1:1, then that means that liquidity is unsatisfactory and the business can't meet its debts as they fall due. If the working capital ratio is greater than 1:1, that might mean that the business has too many current assets which are not being used effectively. Quick asset ratio assesses the business's ability to meet immediate short-term debts by measuring the ratio of quick assets to quick liabilities. So, working capital ratio was current assets, current liabilities. Quick asset ratio is quick assets to quick liabilities. And basically, the difference is if an asset can be converted into cash, then it's considered a quick asset. So, with inventory and with prepaid expenses, those are assets that cannot be quickly converted into cash. Obviously, with inventory, we can sell that inventory, but that cannot it's kind of a difficult process to sell inventory. It's a bit more complicated than, say, bank, which is obviously can be very quickly converted into cash. You can just make a withdrawal from the bank. So even though inventory can be sold, it's not considered a quick asset. And with quick asset ratio, for example, 0.8:1 means that the business has 80 cents worth of quick assets for every $1 of quick liabilities. And we assess quick asset ratio by comparing it to working capital ratio. So in this case, a quick asset ratio of 0.8:1 is not it's not satisfactory because quick asset ratio should be at least 1:1, which means that the firm has enough quick assets to meet its immediate quick liabilities. And sometimes you might have a satisfactory working capital ratio but an unsatisfactory quick asset ratio. And what this tells us is that the business has too many or too much inventory and too much prepaid expenses and not enough quick assets. And the best way to fix this is to increase quick assets or to reduce quick liabilities. Cash flow cover measures the number of times net cash flows from operating activities is able to cover the current liabilities of the business. And this is useful in budgeting the growth or decline of the business. Cash flow cover is not a static indicator. It uses the cash flows of the business in its calculations. So if the business has a low cash flow cover, it means that the business needs a lot of capital contributions from the owner, or it might need to increase its reliance on external finance, or it might need to sell its non-current assets. So basically, quick asset ratio and working capital ratio rely on static figures, but cash flow cover uses non-static figures. So here's an example that talks about working capital ratio compared to inventory turnover and return on assets, and you need to explain, what has led to these changes. Okay, so just while we have a few minutes to conclude, I actually didn't go through accounts receivable turnover, accounts payable turnover, and inventory turnover, because that is something that you all should have covered in Unit 3 of the course. But obviously, if you're not confident and you don't know the definitions, formulas, and explanations of the accounts receivable turnover, accounts payable turnover, and inventory turnover, then 100% you should go back to your textbook, read up on it, and memorize those definitions and formulas, because it's super, super important. I cannot stress how important memorizing the key definitions is to your exam. So, not just the indicators, also memorizing the definitions to the accounting elements, asset, liability, current asset, non-current asset, current liability, non-current liability, owner's equity, the definition of a revenue, the definition of an expense, all of that. Memorizing the definition of qualitative characteristics and accounting assumptions. It's so important, and knowing those definitions and having them memorized is such an easy way to get easy marks in your exam. If a question is saying, why is bank a current asset, you need to have the definition of current asset in your answer to get full marks. And knowing that definition is an easy mark in that exam. Okay, but moving on to exam revision. So the most common question that I get asked is how to answer theory questions. A lot of people struggle with theory questions, but it's not as complicated as you think. A lot of the time with theory questions, you get rewarded for standing out, especially with discuss questions. So when you're answering discuss questions, try to consider other information and non-financial information, which is something that I think I've talked about a lot in this lecture and I've really drilled in. But just to iterate again, it's really, really important to consider non-financial information in your theory responses. But just talking about in general with your revision, it's really important to use this time to focus on revising for your exams and doing practice exams. The best way to revise for the final accounting exam is to do practice exams, because first of all, you're revising the content by answering questions about all of the theory and all of the content, and second of all, you're practicing time management. The number one thing that almost everyone that does the Unit 3 and 4 accounting exam at the end of the year struggles with is time management. I know so many students who never finish or don't finish their exam at the end of the year, because the accounting exam is one of the most difficult exams in terms of time management. It's only 1 minute per mark. And I know saying that, it doesn't sound so bad. A 10-mark question, you have 10 minutes, and that sounds, not that bad, but it's such a fast-paced exam. I cannot stress enough how fast the accounting exam goes. So many people don't finish it. A very, very small percentage of people actually finish the exam. So that comes down to, not just practicing finishing the set of questions in the set time, also practicing doing the questions that you're good at first. So, at the end of the day, no matter how many practice exams you do, and no matter how much you practice your time management, there are so many factors that affect your time management in the final exam. There could be distractions. You could get stuck on a question. There's so much that can affect your time management in the final exam under those timed exam conditions. And so the number one tip that I always give to every single student who's ever done accounting is basically just do the questions that you're good at first. Don't do the exam in order. So for me, when I did the accounting exam, I am better at doing theory questions than I am at doing practical questions. I'm way better at answering a discuss question than I am at preparing an income statement, for example. And that's just me, I'm more likely to make a mistake doing a practical question than I was to do the theory responses, because theory responses were much easier for me. So when I did the final exam, I did all of the theory questions first, and then I did the practical questions. If it's the opposite for you, if you're way better at practical questions than theory questions, do the practical questions first. And basically what that means is, if you do run out of time, the questions you did first are questions that you're better at. And so if you're better at a particular type of question, you have a higher likelihood, a higher probability of getting full marks for the question. So by doing questions that you're more likely to get full marks for first, you're more likely to get a higher score on the exam. So really think about it, do a few practice questions, and like when you're marking them, think about, oh, like I was way better at doing this type of question than I was at doing this type of question. So when you go into the final exam, do the questions you're better at first. Um, Basically just do as many practice exams as you possibly can. There isn't a, set number that everyone should aim for. Sometimes quality is better than quantity. It's better to do, 10 exams, but each exam you sit and you go through the examination report thoroughly, and you identify the mistakes you made, you identify why you made that mistake, and you identify how you can avoid making that mistake in the future. That's better than just doing 25 exams and just racing through them and not properly going through the exam once you're finished. So do as many as you can, but in saying that, for each exam, make sure you're actually going through the exam after you finished it properly and going through the examination report. The examination reports for all VCE subjects, not just accounting. The examination reports for each exam is one of the most valuable resources that you can use in exam revision, because it's basically the examiners who mark the exams saying this is where students went wrong and this is how the marks were allocated, and you can learn from previous students' mistakes. If a high percentage of students are making mistakes with depreciation, for example, say if they're, oh wait, that was a bad example. Say for example, if a lot of students are forgetting to include depreciation in the income statement, and you can learn from that and make sure in your exam that you do that first when you're doing an income statement. Just little things like that. There's so many hidden gems and tips given in the examination reports for all subjects, not just accounting, but especially accounting is really important. But that's the end of our lecture time. So thank you so much for watching and listening, and good luck for your exams, and you've got this.